The only evidence of a multi-billion-dollar financial operation by the United States government is a doodle on a notepad. It was a handwritten to-do list sitting on the Treasury Secretary's desk, ordering the purchase of billions of Japanese yen. On the morning of July 31st, for the first time since 1998, the United States Treasury entered the currency market to buy Japanese yen. To pay for this without asking Congress, the Treasury tapped into a specialized account called the Exchange Stabilization Fund. It functions as a personal piggy bank for the Secretary, requiring only the President's signature to open up the credit card. But America didn't buy those yen with dollars. It liquidated roughly $13 billion in European currency assets, and they executed the trades before even notifying the European Central Bank. Dumping a massive amount of European currency without warning to execute a covert trade breaks decades of financial convention. The Treasury took an extreme measure, which leaves us with a single question: why did they do it? If you ask officials from both countries, they'll tell you this was an act of diplomatic goodwill. They claim Japan simply needed a little help stabilizing their currency, and America stepped in to support a friend. Yet, just 8 days before the intervention, the U.S. Treasury published a report placing Japan on its official watch list for artificially manipulating its currency. The official story about friendship doesn't match the Treasury's own internal data. Labeling Japan a risk and then spending billions to support them just 1 week later suggests a motivation more urgent than diplomatic goodwill. Inside Tokyo, the Bank of Japan is trapped by math. They owe more relative to the size of their economy than any major country, meaning they have to keep borrowing costs near zero just to afford the interest payments on their colossal national debt. While Japan pins its benchmark rate around 1%, American rates sit significantly higher, creating a massive yield gap between the two nations. Global capital has absolutely no loyalty. Investors will always abandon these low-yield environments to aggressively chase higher-paying returns elsewhere. This line chart visualizes the dramatic consequence of that capital flight, showing the value of the Japanese yen plummeting to a 40-year low against the US dollar. Because raising rates would trigger an immediate domestic default, Japan is paralyzed by its own monetary policy. Their only remaining weapon to defend their money is direct market intervention. To intervene, you need dollars. Japan has plenty of them, but they aren't sitting in a checking account. They are locked up in U.S. Treasury bonds, making Japan America's largest foreign creditor. To defend their currency, Japan forcefully liquidated exactly $66 billion in American government debt in a single month. This flowchart maps out a mechanical trap known as the FX intervention feedback loop, or the doom loop, triggered by Japan's bond sell-off. First, flooding the market with unwanted United States bonds naturally drives the price of those bonds down. Next, because bond price and yield move in opposite directions, the U.S. government pays higher interest rates to borrow new money. Finally, rising American rates widen the yield gap. Capital flees Japan faster, driving the yen down, starting the cycle over. Japan spent billions only to actively accelerate the collapse of their own money. And as a direct side effect, they drove America's cost of borrowing to its highest point in nearly 2 decades. The Treasury Department recognized the math. Their largest foreign lender was perfectly willing to become a massive seller of American debt to save itself, creating an urgent supply problem that America had to stop. The solution was sitting over at the Federal Reserve. It's a tool called the FEMA Repo Facility, which essentially functions as a geopolitical pawn shop where foreign central banks can temporarily exchange their bonds for cash. By handing over their bonds and agreeing to buy them back the next day for a slight fee, Japan gains immediate access to the necessary dollars to defend the yen. Most importantly, it allows them to do this without ever dumping American paper onto the open market. We know this was the goal because of the timeline. Just 48 hours after the secret yen purchase, Treasury Secretary Scott Bessent publicly urged the Fed to expand this specific facility, despite the fact that its balance was sitting completely empty. The Treasury used the stabilization fund to neutralize Japan's selling pressure, shielding the American bond market from further volatility. When a foreign nation holds more than $1 trillion in your debt, their currency collapse becomes your domestic crisis.